25. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Mike Butler in studio in Chicago today. Dylan Radigan will be back next week. We're here for the next hour. Futures market closes at 5 Eastern, 4 Central. If you're on the platform, Tasty Trade, on the website, tastylive.com. Thank you for joining us. Welcome to the show. Come over to YouTube. Tell us what you think of this market today, where good news is good news again, Ilya, because retail sales beat expectations and initial jobless claims were a little bit softer than anticipated. A market likes good news, and so stocks led by your Russell 2000, small mid-cap growth, lead the way today. Likewise, we see a NASDAQ close at fresh all-time highs on a seasonal peak of the market for the month of July, at least for the next 2 weeks. But it was a buy America kind of day, Mr. Butler. What did we see? Bonds up, gold down, dollar up, and stocks up. That's a sign of faith in this market as volatility continues to come in. We have a lot to cover here today, though. Mike, I'm going to give Ilya a quick second to collect his thoughts as our resident bear here. And as a fellow bull.
Oh, my thoughts are collected. Don't you worry.
as a fellow bull who is trying to fly close to the sun before our wings melt, how are you handling this market?
I'm laughing every time I open it in the morning. And I'm really just keeping positions light. I mean, when volatility is low, there's not too many opportunities to sell premium. So I'm going more the diagonal spread route. I'm kind of cherry picking certain products that have higher implied volatility. Like I've got position on an IBIT, which is a great Bitcoin vehicle. I've got Ethereum positions on now and ETH. And then just throwing on some earnings trades. Like I had an earnings trade in Netflix today. So just keeping things light until maybe something shifts here. But until that happens, I don't really want to have a ton of risk on. But I'm still playing it to the upside because permabulls seem to prevail time and time again. Right, Ilya?
I mean, so far.
Before you get into it, Ilya,
S&P didn't break its high, so
we have Netflix earnings.
I remain undeterred, but whew.
No, Netflix earnings are out here. EPS of 7.19 beats the estimates of 7.06. Revenues 11.08 versus the estimates of 11.05 billion. It's down a little bit here after hours. Mike, I saw a piece of research today suggesting that the last 10 earnings reports have produced an average move of 8.5% in Netflix the following day. Maybe that's not right. That seemed a little high. But I believe that the implied move for today's earnings report was like right around 7.5%. What do you take of this? Did you have any plays on? You said for Netflix. Is this a Netflix and chill market?
It is. Yeah, I think they were due for an inside move. I mean, they've just had an explosion to the upside. I personally think this is kind of a front-running move to new deals and new exposure to different sectors. I think Netflix is going to land UFC. I've been thinking that for a while, but it seems like there's more news that's coming out, and I think that could create a template for a lot of other major sports leagues. I know NFL already is involved. You have some boxing events on there, but you could see a lot of other revenue drivers. I mean, they made a killing last year with just like a handful of NFL games. So, and then of course, if you consider the fact that they're probably going to split the stock price, I would assume at some point here, maybe a 5 or 10 to 1 split, that makes it more accessible for anyone that wants to invest in it. I mean, it's craziness. But yeah, to your point, pretty decent expected move, almost 80 points. I threw on an iron condor in August. There's really nothing else you can do other than credit spreads or debit spreads that are kind of narrow in a $1,200 product. So I had my short options were at 13.15 to the upside and 11.50 to the downside. So almost a 200-point range with 30 days to go. I collected half the width of the risk and just figured, even if it was a big blowout move to either side, a 200-point range in a product like Netflix, as long as it passes through your range, if you do nothing, you'll be fine over the next 30 days. So we'll see. If we open up down 10 or 20, that'll be like right in the middle of the spread. If that's paired with a nice vol crush, maybe we can see $150 come out of there overnight.
Well said. Netflix here, I don't see anything about a stock split just yet, but we'll keep an eye on that here. Tom's talked about how this is, given where the pricing is, it's a little bit of a difficult product to trade, but revenues are up 16% over the quarter. That's not too shabby.
Tell
Ilya.
you what, though, this is a surprise relative to forecasts of just 1.7%. So this is, I mean, it makes sense that Netflix is idle here. This is bang on expectations for the most part, especially when you compare it with a 16.5% beat last quarter. So it seems to make sense that there's a level of benchmarking here where the markets kind of said, well, how many quarters in a row can they do this? They obviously surprised markets by a lot last time, and analysts adjust. So this is pretty much as expected.
You put out a quip that the S&P 500 wasn't looking like it was cycling to a new high today. I would digress and suggest otherwise, but
it didn't close above it.
Why do you think that the retail sales report today was hollow, which the market seems to be celebrating?
So the market looked at the headline figure, and the headline figure was unmistakably better, 0.6% versus 0.1% expected. And then, in fact, if you actually go down the list, all the various kind of permutations of the retail sales data, excluding this, excluding that, holding this constant, holding that constant, all of it better. But there is an important detail here that's missing in the headlines. And then when you look under the headlines at the components that made up this thing, you find something a lot more soggy. So motor vehicle sales make up about 20 to 22% of overall retail sales. It is by far the dominant component. That should be relatively straightforward. What is the most expensive retail thing that people buy other than housing, for which there is a separate set of numbers because housing is obviously huge and special? It's cars and vehicles of every kind. So not surprising that when you count up retail sales and take volume multiplied by dollars spent to get a value, and then you look at that over time, motor vehicle sales are going to be the biggest thing. Well, if you look at what motor vehicle sales did this month rather than the previous two, you get a nice little bounce of 1.2%, except for in May and in April. In May, they fell 3.8%, huge. In April, they fell 0.7%, not small. So you take this 1.2% bounce, and what you end up with on net is retail sales fell about 3.3% in the second quarter. That's after the weakest contribution from consumption to first quarter GDP in almost 2 years. And the only thing that really matters for GDP is consumption. It's 68%, 68, 69, depending on the quarter, of the overall total. So what these numbers tell us is that after a soggy consumption quarter in the first 3 months of the year, we're going to get a second one in the second. That the second quarter is again going to be weak in the one area where you don't want to be weak. And the Atlanta Fed GDP Now cast, which was, of course, updated with this data, very pointedly showed you exactly that. Now, never mind whether this forecast is right or wrong on the number itself. That's not significant. We're still a ways away from second quarter GDP data. A bunch more numbers are going to go in the pot here, and we'll see. The important thing is when they published their update of the model just today, they said, we have to lower our second quarter GDP forecast in the wake of these better than expected, quote unquote, retail sales numbers. Because what we actually have to do is we have to revise down, and I quote, personal consumption expenditures growth. Now, you'll show us surely in a second that some of this was an inflation adjustment because we had untoward inflation data earlier this week, showing us both in PPI and in CPI, most importantly for retail sales because that's consumers, that tariff-based inflation is finally starting to show up. So none of this adds up to a happy quarter in the second quarter and through then the first half of the year for the most important catalyst, the most important engine of U.S. economic growth.
Tech closed at highs today. Banks are closing near highs. At least you see KRE and
well, I mean, as ever, the economy is not the market, and the market is not the economy.
That's the case, Mike. Why wouldn't we keep this rally going, even if it's a hollow retail sales report, as our Soviet friend contends?
Rallied on the hollow report.
I think you will see it continue higher. I mean, really, if you just isolate volatility and the impact of low volatility on markets like the E-minis and NASDAQ, you will almost always see a slow grind higher. Now, the last couple of weeks have not been a slow grind higher, but I think what you've seen from July 3rd on, where we've just kind of like chopped around, volatility continues to contract, we keep pushing to higher highs. I think unless something changes where we see bigger moves day to day and a vol impact that is sizable, I think we will continue to see this just grind higher. I hope we don't. Honestly, I hope we get more two-sided action. I want to see more 100-point moves in either direction. But you know, when we're at peak complacency, which is what it feels like right now, that's typically when fireworks start to rear their head. So we shall see.
Why do you say peak complacency? What metric do you use for that?
When I say that, I'm just looking at like the VIX. VIX is at 16, making new lows every day. It's not as low as it was a couple days ago, but it's trending towards that line. And we've stayed elevated, which is interesting. We haven't gotten back into the low teens. But I mean, a VIX of 15, 16 is typically a grind higher type environment, I would say.
We like doing sentiment checks around here. Do you think the official White House Instagram account putting out a AI video of American eagles dropping Benjamins everywhere is a sign that maybe we're close to a top?
Maybe.
Wow. I didn't see this today. This is almost better than an Economist cover.
It might
from
be.
A guy.
I feel so much better about my shorts.
From a guy, an administration, the first
week of April. I wish you shared this with me sooner.
First week of April, Besson saying things like, for years it's been Wall Street's turn, now it's Main Street's turn. I'm not looking at the stock market, right? Isn't that what the president said on several occasions in March and April?
Hassett said there's a 0 chance of recession, which means there is a 100% chance of recession.
It's all it's a little too funny. So yeah, things feel a little frothy, right? We have our little sentiment checks around here, but the White House celebrating the market up at all-time highs feels a little different than the attitude they displayed in March and April, and certainly the first week of April. But then first week of April, Trump starts saying things like it's a great time to buy stocks. And if you listen to the president, it was a pretty good time to buy stocks back in that first week of April. So maybe the fact that they're celebrating means that they're just going to pump this thing, Mike. They know how much it means to people that crypto's up and stock prices are up. And, you know, if they can't bring down yields, at least they can give people a wealth effect.
Yeah, I mean,
market's just ripping right now.
Yeah, there's always that angle too. But I think it's interesting too. Like I've been checking the interest rate forecast every day, and almost every day we've been getting a higher and higher probability that there is no cut in September. What is your
Meanwhile,
feel for
the
that?
2026 outlook keeps getting more and more dovish. The markets are pushing out the cuts. In fact, they did it again today. in the wake of these, again, quote unquote, better retail sales numbers. The upshot from the markets was right. So it's not that anything is great. It's just that it's going to get pushed downwind again, which, by the way, obviously makes sense in terms of the inventory build, in terms of the front running of tariffs that we saw in the first quarter. I mean, there was a 40% swing in imports. We're only just now in June, based on the CPI data this week, starting to a little bit notice that goods inflation is creeping into the market, and into the economy. So we're starting to see it, but of course it's delayed. The great unknown is how long, and the markets are clearly saying, right, so the Fed is resistant. They're maybe not even going to get off a second rate cut this year, maybe just one. They're down to 38 basis points for this year, to Mike's point. For next year, they're out to 73 basis points against the Fed's forecast of 25. So the markets took this data not to mean that things are good, but that things will get worse later.
I don't know. Bond yields at the long end of the curve were down today, all while stocks rallied and the dollar
moved up. I would go so
up.
far as to say they were up or down. They didn't do much of anything. In fact, they've been stuck, basically.
Let me put it a different way.
Basically.
We had a decline in Fed funds expectations at the start of the month. When we started to see those July cut odds go down towards zero, when we see the September odds go from like 70, 80% to where at the market close today, it's a 55% chance that the Fed cuts in September. That is so on the line. We haven't had to bring up this stat in a while, but it remains true. Go back to 1998. Every time there's been a Fed meeting, the day of the Fed meeting, as long as the market's been pricing in a 55% chance of something happening, the Fed's done that outcome 100% of the time.
Right.
So if we were to go into the September meeting, a cut is priced in, but at 53%, there's no guarantee that even though it's favored, it actually happens by the historical metric. But I would point out that while we see the erosion in Fed cut odds throughout July, we see bonds get hit, and yet today it's a Buy America day. Cut odds are down, but for perhaps a good reason.
Well, yesterday we had the spook that we had, clearly, right? And what we saw was this sell America dynamic around the idea that perhaps the White House would be so foolish as to try to fire the Fed chair. And to the White House's credit, within an hour of the rumor mill starting to spin, the president came out and said, whoa, no. That's not what we're doing. So today the bonds do nothing because, again, there was a conversation with the president and he decided he was going to undo some of his own calming effects yesterday and said, we're not going to fire Powell unless it's for fraud. You go, wait, what? So
that's what this whole Fed renovation story is about. They're trying to dig something up so that they can find reason to find cause to remove him.
Right. So this just tells you that it's not that the president has some sort of institutional instinct that would prevent him from an illegal firing of a Fed chair, which even the Supreme Court has now told him is not a thing that they're sanctioning. But it's that they need an excuse. And so the bonds essentially go nowhere today and go, well, this is either red meat for the base or some kind of something. This maybe prolongs using Powell as a bogey, as a talking point. Maybe there is no intent to fire him. Maybe there is. Maybe they find something. Maybe they don't. Obviously, they're attempting to drum up some sort of kangaroo court situation with the renovation of the Fed's buildings, as you were just saying, Chris, in Washington, D.C., which absolutely no one cared about for the longest time until suddenly an excuse was needed. Echoes of the Soviet Union ring in my head as a former Soviet. But when you look at all of this in context, it makes sense that the bonds don't exactly reflect Fed policy odds in a clean way, because this whole, are we going to tarnish the Treasury as a risk-free asset now and for all time, is a big, big, big deal. And it's not looking as safe today, perhaps, as it did yesterday, at least not in a convincing way.
Okay, Mike, so we move away from the bond futures themselves and go to the more approachable product for most retail traders, which is TLT.
Yeah.
This is near a multi-year low, like the lows that we've seen since 2006.
Staying long, baby.
Oh, yeah.
What do you do here?
Yeah, TLTs. I like TLT as a zebra product. So zebra is just a back ratio. So where you're buying two options in the money and then selling one at the money to remove all the extrinsic value. Basically a synthetic stock position, but for much less capital than actually owning stock. So I'm in the TLT position. I've been in there for a couple of weeks, but I've got the 85, long two of the 85 calls, short one of the 88s in August, 29-day cycle. Paid $500 for it. It's down $200, $300 right now, but it's right there. If you get a move back to 86, 87, it'll be a decent trade. And if it goes higher, it'll be a really nice trade. But yeah, it's trying to get off those lows, but someone in the YouTube chat said, as long as we have uncertainty about Trump firing Powell, bonds will stay heavy, haven't recovered from where they were. Interesting point, but yeah, I'm playing it to the long side. I think it's a low vol product. You can do a lot of different things in there, and you can get cheap delta in there for sure.
Yeah, you mentioned Zebra. People have asked this before. It's zero extrinsic, ZE, and then back ratio, BR, ZEBR.
Yep.
That's where the name comes from. It's basically a near 100 delta replacement strategy, so you can get synthetic stock exposure without having to lay out all the same capital.
Yeah.
Just going a little bit deeper there, Mike, because I know even for me, right? Like I'm like, oh, Zebra. Okay, yeah, okay, got it. A little bit more complicated of an option strategy, but as you point out, it's a way to contain your risk here, given what's going on, and take a shot, because this is maybe the commenter in the chat has a point, right? There is a term premium, Ilya. We shared that chart earlier this week, where since April 2nd, given where notes and bonds have historically traded relative to Fed funds futures, you would expect 10-year notes to be about 40 basis points lower had April 2nd not happened, because the relationship has changed. And so selling puts is different than buying calls. I can tell you, I've had dog luck with buying calls in bonds. But for those who've been directionally neutral, the directionally neutral trades have been working fine. It's just being directionally aggressive to the upside's been hurting me, Ilya.
Moreover, by the way, the term premium share in the 10-year yield today increased again. It is now back toward the highs that we set in late May, just 2 basis points off, as a matter of fact. And the term premium, I know this is going to be shocking, has been rising since just about October 2024 and really broke out in November 2024. Before then, from about October 2023 and up into the election, the term premium was actually declining as a share of the 10-year yield. One might say with the election, folks started to want to be paid more for uncertainty risk embedded in duration.
You know, it's a nice place to protect yourself from uncertainty. Silver. Silver's up today. Silver is the most beautiful. Ilya, come on. I got to get you to buy something.
It held in such technical perfection. You look at this and you go, well, you can naysay technical analysis all you want, but I didn't make this price action happen. This isn't an AI-generated chart.
It was Dylan cornering the silver market again.
Is that why he's out today? He's celebrating a successful hunting?
Yeah, with his good, very nice. With his 5-lot SLV call spread. Yeah, that's still a bit in the market.
Yeah.
No, but it's such a clean, it's like 37.70 or so, right? It's give or take 73 here on the high. Yesterday, the low was 75. Today it was 68.5, I believe. Yeah, it's 37.68.5. That on the 4-hour chart, former resistance becomes support. We've just seen this recently here in silver not too long ago, where we had the former highs, right, from October and March that more or less, again, once we broke through, resistance becomes support. This thing looks really constructive still. And silver's one of those assets where, like, yeah, we got a little bit of growth tilted data. Are we going to be deficit spending? Absolutely. Why not go back to $40? Mike, do you have any precious metals exposure? Because Ilya, Dylan, and I, Jamal, we've all been jumping in long on these things in some form or fashion.
I'm sitting long gold for the record, and I think it's held up heroically over the past couple of weeks. So I'm happy.
Yeah, I had a bullish position in gold futures in the Q contract, and I just threw on a neutral-ish position in the V contract 40 days out. Just a wide iron condor there. The short options are at 3,200, 35, 35. So, yeah, we'll see where that ends up. But just wanted to get some kind of neutral, choppy premium in there. But it is interesting to see silver catch up to gold, the gold-silver ratio getting a little better. It feels like the exact same scenario as Bitcoin and Ethereum, where Ethereum is continuing higher while Bitcoin kind of chops at highs. But yeah, definitely involved in gold and silver. And I think they're very similar to TLT. If you're looking for cheap delta, silver, like SLV and GLD, are two products that kind of offer that. Not at the same degree as TLT, since TLT has a lower implied volatility. I guess GLD is very similar in implied volatility, but SLV is a little bit elevated. But $35 stock, you can get pretty cheap delta in there too.
Yeah, we didn't see a big push higher in gold today, but it is worth noting that we do have a nice pull up here as the session goes forward. We bounce off of that 50-day moving average, which we have on several occasions here, early April, right? Again, here in May, and we hold it at the end of June into July. The triangle continues. Mike, I think your approach, honestly, it's been the better approach for the past few months. I've been riding the rails up to the long side on various out-of-the-money calls, and that worked great up until early April. And for the past few months, I've basically just been throwing away money, right? Betting on high convexity trades, 4-to-1, 5-to-1, 6-to-1. And I get a few days where maybe it works out, and then I find myself having to roll the position back basically where I entered. So it hasn't been great for me. But what you pointed out here, going directionally neutral, I couldn't help but just size it up on the chart myself and thinking, what if we hold the May low? What if we hold the April swing high here? What if we were to go out to 70 days and you were to construct a potential trade in this neighborhood, and you could find yourself going $25 wide in a short call spread, this is 40 days, short call spread, short put spread situation. And you can get yourself close to that 60% probability of profit, and you're risking 3 to make 2.
Yeah,
it's not terrible. It's actually a really decent risk to reward, all things considered. And my last checkpoint for this would be how much buying power am I laying out relative to the profit potential here. And I always like when my profit potential exceeds the buying power. So this kind of checks the box for me. Even if I'm going to be directionally bullish, I may want to augment this and add in something that's a little bit neutral in case this thing continues to stall.
Yeah,
it inspired me here.
Yeah, I mean, this has been a really nice trade. This has been one of my favorite trades of the year, is just doing gold futures broken wing butterflies with the intent of, like, if I do it on the call side, for example, where I want it to drift higher slowly, if I throw it on the call side and I'm collecting between $250 and $400, which is typically the setup if you're doing it 20 points wide, 20 by 40, where your long spread is 20 points wide, your credit spread's 40 points wide. If there's a sell-off of any kind and you can remove the risk by turning that 40-point wide credit spread into a 20-point wide and basically legging into a symmetrical butterfly, you can usually do that and lock in a 60 cent or $100 or $150 credit. And then you're ultimately legging into a wide butterfly on the side that you want the product to go to. And if it expires worthless, you keep that small premium. But if it doesn't and it rips towards your spread, you can sell out of it for a greater value. So I've literally had 6 of those in a row. 1, 2, 3. All 6 of them have been profitable between 50 cents and $250. So
very nice.
And that's because even with gold's rally, if you look at a chart of gold, like, yes, it's had these crazy rips, but it's been two-sided to a strong enough degree to where you can remove that risk in those butterflies. So I think I'll keep doing that as long as we see this kind of chop around.
I mean, in effect, where do we find ourselves right now? And this is, where do you want to put on an iron condor? Generally speaking, I like to do it at the midpoint of a trading range. And so when I take a look at the chart right now, I see where our gold prices. These are really ugly colors. We're going to fix all this up. Yellow, yellow, yellow. And goodbye. Okay. So literally the 50% mark of the trading rate post-Liberation Day high to the post-Liberation Day swing low here. You're at the 50% mark right now. Right? If crude's a good play, Ilya, from the post-Liberation Day high to the Israel-Iran war high, that swing area, okay? We go from here to here, and the 50% mark's right around $66, depending upon what contract you're looking at.
Yep.
Got to play it neutral. Now, the only quip I would have here, and the one thing that's getting at me, the positioning may be a problem. Even with yesterday's news out of the administration, the snip, snap methodology of deciding whether or not we would have Fed Chair Powell continue in his role, we get the pullback from the 50-day, and then we immediately get back up there today, Ilya. And that's because, in my view, this is an exceptionally crowded trade where people are now trying to get out of their short dollar exposure.
Mm-hmm.
And so knowing that short dollar exposure, a leg of that is also long gold exposure. It's one of the reasons why I'm thinking that Mike may be onto something here with playing directionally neutral, and maybe we temper our enthusiasm, curb our enthusiasm. How did I miss that? We curb our enthusiasm about gold's directionality to the upside, maybe play it a little bit more in silver. And if the dollar keeps rallying on this Buy America type of setup, then our gold position may have some problems ahead.
Thankfully, the way that I have my gold position is expressed is through short premium. So I've actually just sold puts, and that's how.
Look at you, fancy.
I have it. That's how I've had it on. Well, no, it's a vertical, not to worry. I'm staying very, very risk defined in these wacky markets.
In fairness, if I was selling puts as opposed to buying calls, all of these trades would have worked out. That's really my issue.
Yeah.
It's the way I structured my opinion.
I looked at vol when I was putting this on, and this is already after an initial roll, and it looked too expensive, and so I did it this other way. And so I'm okay to continue to sit. I've not only used verticals, but I've also given myself a lot more duration this year. So whereas the tasting methodology might call for, let's say, 45 days in, I've been getting closer to 60, just because I want to reduce my direct exposure to the underlying moves, because these markets have been really, really choppy. I want to give myself a lot of time for things to work, because whereas macro is already a very difficult thing to time, now it's just look at the term premium surging, an even more difficult thing to time. So I'm fine with gold basically idling here. I don't love silver, not because it doesn't look great. It does. No question there. It's just silver has this sensitivity to overall risk sentiment. And if you're going to be bearish, as I am, on overall risk sentiment, gold is your vehicle most likely, and not silver. The dollar rebound is very interesting in this context. I am very long dollar at this point. I've been layering it on essentially for 2.5 weeks now. I started with the pound, added the euro, doubled down on the Aussie just overnight as it made its break, doubled down on the yen last week. So I am very long dollars at this stage, having been very short in the first half of the year. So I've almost completely flipped over the boat. I'm not quite as long as I was short at the end there, but it's getting there. So in my mind, what this becomes isn't so much a Buy America thing as it becomes risk aversion, whereby the dollar is again a haven. Because we've gone through the bit, I think, in April where the markets had a genuine concern that, oh my God, we are going to break the US dollar-based global commercial order and surgically extract the dollar and the US Treasury bond out of their bedrock role for modern finance. And then as we force the foundation out, the house can do whatever the house likes. We know what happens to houses when you extract their foundation. So in having kind of settled that concern, April through, let's call it, the end of June, you get back to a dollar, which we can see how it's behaved around the recent spooks in markets. It's gone higher. So I think you're back now to a dollar that's going to be a sort of refuge of last resort if there is a push for de-risking and liquidity. And that's still sort of the world that I'm seeing.
Mike, what themes should we be thinking about for the second half of the year? Is it still AI? I know AI is very much in the news today because of Coldplay, but there has to be
nice,
other reasons. I would encourage people to listen. When this company IPOs, I will probably be buying some of the shares. Because if they could get to market, after surviving this debacle,
it's gonna be a meme stock just because of this debacle. That's the best part.
What was it in Knocked Up? Like, oh, you listen to Cole? Okay, never mind. So, is AI still the most prevalent theme in this market, Mike? Jokes about adultery and infidelity aside.
Yes. I mean, it's definitely going to be a focal point for sure. I kind of like the nuclear products that in theory should drive the AI movement, like SMR. You're seeing that rip to highs.
Okla's doing nice too here the past few days.
Yep. Yeah, I think it's just another way to get involved, but not directly in like a product like NVIDIA that's $600 trillion now, 4.02 trillion on its way to 5. But yeah, I think it'll be interesting. And really, I think this earnings season will be interesting too, because last earnings season, they had the luxury of just saying, oh, we can't tell you anything because pending tariffs. But now it's like things are getting more clear. I think we're going to get more. I think the market is expecting more from these companies now that tariffs are getting more clear. So I think we could see some big moves in some single name stocks. But yeah, I think the tech space is obviously thriving. I don't see why that would change unless there's some dramatic shift in the market as a whole, specifically because of the concentration in these tech stocks in the NASDAQ and in S&P 500. I think that is what we saw to a pretty strong degree in April. And, that concentration is not changing. If anything, it's getting more concentrated with people FOMOing into products like NVIDIA and Microsoft and all these other ones that are at all-time highs.
Oh, yeah. I'm going to guess that your theme of the second half of the year is growth, which, in fairness, we did share a stat a few weeks ago, right, about the S&P 500's recovery. This was just the 9th time in history where the index was down by 8% or more at one point in the first half of the year, only to close the first half of the year in the green. 6 of the previous 8 occasions saw the S&P 500 close the second half of the year even higher, but the only 2 occurrences where it did not, 1957 and 1990, were years in which recession came out of it. So we had said back a few weeks ago, the game that we're playing now as bulls is basically, are we avoiding recession? And so you'd have to forgive me then for thinking the retail sales data today is better than expected on all accounts, the inflation adjustment aside. Recession's a little bit less likely at the margin. That should be good news for stocks because that's the game we outlined a few weeks back.
That's actually not what I see at all. I see that
of course not.
No, and neither does the Atlanta Fed, because they revised their consumption component in second quarter GDP down, not up.
Which is a story, by the way, we wanted to get to earlier. Sorry to interrupt you, but this is a long-standing story of what's been going on with retail sales the past few years, where part of the reason why the Atlanta Fed revises things down is because they make their inflation adjustment. And if you take a look at this, comes from Greg Dackow over at EY Parthenon, their chief economist. If you were to adjust retail sales going back to basically the start of 2021, they're flat in terms of volume. The reason why they're higher is because of inflation. And this is one of the quips that we see with the actual spending data. Today's a nominal release. So it doesn't really tell you what's been going on if there's been a big push higher in prices behind it. Because, again, at the end of the day, P times Q equals GDP. So if prices go up and quantity of goods stays the same, you've actually have a bigger GDP number. But you're not actually moving more product. I digress, Ilya. Right. Your point?
Well, that's exactly it. So what this chart is telling us is basically that retail sales has been soggy since basically the beginning of the year. And of course, we already had the first quarter GDP number. It was negative for reasons completely unrelated to retail sales or to consumption in general. Obviously, the huge 40% swing in imports was a very anomaly-like development. So was the surge in the investment component because all of those imports went into inventory. That's now cushioning consumers from costs, as are wholesalers that are eating into margins to cushion consumers from higher costs. We saw that in the PPI report for the third consecutive month yesterday. But nevertheless, you take all of that noise off the table, because that's just statistical anomaly, whatever. We had the weakest consumption as a component of GDP in the first quarter since the second quarter of 2023. This retail sales report nominally, forget inflation for 1 second, because that actually makes my point stronger and makes this look even worse. Let's look at the nominal side of things, because the rising inflation in June flatters this somewhat. So let's take that impact. Even still, retail sales on net fell by about 3.3% over the course of the second quarter, because the declines in May and in April far outstrip this bounce in June. But of course, the bounce in June is forceful enough because motor vehicles are such a large component, and that's where the recovery occurs, to flatter the headline number, one headline number. If consumption, which is 69% of the GDP total, is getting weaker into the second quarter, the risk of recession isn't lower, it's higher. Now, are we going to get a recession confirmed in second quarter GDP numbers? Almost certainly not for any kind of underlying consumption reasons. If anything, we'll have more chop around the tariffs, but the negative number in the first quarter wasn't a real negative number because of all this weirdness. But that's
how many recessions have started with a 40% surge in imports?
This is a weird thing, right? Because this surge in imports is not a reflection of consumer demand. It's a reflection of companies trying to pull orders forward because they don't want to pay tariff rates later. There's still this is why you got a massive parallel surge in inventories. It's not like this 40% jump in imports, like, oh my God, everybody's buying stuff. Import more. No. It all went into warehouses, waiting. So that's going to smooth out how much goods inflation consumers see. It's not going to get rid of it. And when we look at what wholesalers have been doing, they are already fighting a losing battle because they continue for 3 consecutive months now to eat the input costs. And yet in June, the goods inflation numbers in CPI started to creep up. It's a losing battle. They can only eat margins for so long. They will pass it on.
Probably fourth quarter.
They're not going to take themselves out of business for the sake of not raising prices on consumers, because of course they're not doing that so as to protect the demand. But
they're talking about this in their earnings. A bunch of companies are saying how they're working on supply chain management right now, and they'll worry about revenue management tactics later on, which is basically saying we're going to figure out ways to get deals. We're going to start cutting promos, and hopefully when we raise prices, we can make it up on volume.
Yeah.
I mean, that's the playbook that Samuel Rhines over, I think it's Employ America, has a really good article about how businesses are going to navigate this environment moving forward. Mike, we got 5 minutes left here on the day and the week. Netflix's earnings are helping propel the Nasdaq here higher after hours, 23,251. We're not the exact high, but it's pretty darn close. This would be a high 4-hour close of all time. Do you care about seasonality here and the market that tends to get stuck in the second half of July? Does that matter to you whatsoever?
Not necessarily. I think there's always interesting data points when you look at long-term analyses for certain months or certain quarters, but I think right now there's a lot of pending things. I mean, a lot of stuff is potentially priced in, like the Bitcoin rally we saw up to 120K. I think that was pricing in what we're seeing today with the passing of stablecoin legislation, and this week is crypto week, blah, blah, blah. So, I think the market always knows first, and I like to listen to what the market is telling me versus my own assumption. But again, I think if we stay in this 15, 16 VIX, how are we going to drop from 6,300 to sub 6,000? I don't think it's going to happen. I think we would need to see the VIX pop back to 20, 25, 30 before we get down to those levels. And that obviously makes sense, but we need that kind of volatility pop before we see substantial moves to the downside. And if we don't get it, I think we'll still see chop. Don't get me wrong. I think we'll still see days where we're down 100 points, 150 points. But I think the trend is up and to the right, for better or worse.
Up and to the right until it's not.
Yeah, I mean, yes. Exactly.
And also, Elliot, the screen was from Ryan Decker over Carson Research. Oh, no, go ahead. Sorry to interrupt you, Mike. Have the floor.
Speak for yourself, Ilya. I bought 100 Lulu joggers, so it is not company's front-loading inventory. It is my demand.
Nice.
All kidding aside, but yeah, they're doing that.
I'm more of a Viore person. I'm finding those to be.
They're great.
It's all about Mac Weldon, gentlemen.
Me and Nick are both Viore boys.
Excellent. Good for you. And see, that's why we get along. We understand the sports betting and the attire.
Yeah.
All right. Ridiculous stories to close the week. What's the most ridiculous thing that we've heard in the market this week so far? I don't know if there's a good corporate story out there, if there's anything good about AI, if there's anything good about the Fed.
It's gotta be the NVIDIA story. Come on now.
NVIDIA now being worth more than the Japanese stock market.
NVIDIA being allowed, NVIDIA having restrictions on H2O chip sales to China lowered because we're in a trade war, everybody.
I think it's the White House pump it up meme. Like that's
that's a good one too.
The most wild thing I've seen.
I mean, isn't that? I think that's kind of validating though, in the sense that, I mean, Ilya, you're here every day with me. I've had a very stupid point of view that they're just going to pump it. And, you drop a meme of American Eagles making it rain Benjis. I don't know. It kind of feels like we were right.
Yeah.
It's getting ridiculous. Yeah. It's getting so ridiculous. But you know what? We're here for the ride. Sticking with the same things. I'm not in tomorrow because we're celebrating our 36th turn around the sun. But leaning along the NASDAQ, 23,350 calls, 23,350, 500 call spreads with an expiration of Monday. So let's make it happen. Just 100 points. That's all I want. Just 100 points between friends. Likewise, though, still along the S&P 500, like 59.75, 6,000 put spread. That's dated for the last week of August, because I think we are, Mike, we're in this, let's blow off the top, get a little crazy. Bonk is up 18% pre-market today. When the meme coins like that and all the, what do they call them? The shitcos, when the shitcos start going, that's when. Yeah. So the signs of a peak are getting close and we're near a seasonal top. Volatility tends to bottom out in the third week of July, which we have now entered. So buyers beware. But I suppose with that, overtime is now out of time for this Thursday and this week. We'll be back next Monday, same time, same place, 4 p.m. Eastern, 3 Central, as always, right after last call. So for Ilya Spivak in San Francisco, Mike Butler in Chicago, I've been Chris Vecchio in New York. Good luck trading. After this, brief break, and then Ilya's back with macro money. See you there.
See you there, everybody.
If you missed the live show, here's our cherry on top weekly recap.
I did let off fireworks. I should have brought a video. I honestly have never paid attention to the amount of powder in there. And they say it. So like those are like 200 grams of powder, right? And so I got a 500 one this year. So it's usually me and my youngest Austin. Literally, it's like this. It's like. Nah, dead serious. Like I don't mess around.
Tom and I normally park on the same level in the parking garage. And so when I go to get out of my car, I have all my stuff, and I see big signs on the door, elevator out of service. I was like, that's not going to be good for Tom.
I looked at it for like 5 minutes.
And he was like, blink, blink, blink.
I'm like, this has to be a mistake.
So what he's doing now is he's asking people around the office if they will go get his car for him because he can't walk up the 4 flights of stairs.
I see you looking at my hair. You're like, you keep looking above my head.
Who can't? You've got the beard, and I mean, are you like showering with Rogaine or something? What's going on? You're like going full Sasquatch.
I don't understand.
I have not been able to spend the time.
Sasquatch.
The sassy guy. Yeah, look at him. He's proud to wear it.
I was trapped once on the air and water show.
Oh.
I was trapped on a boat, like a big giant yacht for an air and water show.
These are not actual problems.
Yeah, it was. We were 200 yards off of the North Avenue beach, and I could have, technically, if I could swim, I could have made it in.
Okay, but you can't swim. We've already discussed this. You have negative buoyancy.
I went to America's Cup race here. It was the trial.
Look at you with all these rich guy activities. America's Cup.
No. Remember they had the trial for it?
I am black.
I went to that on a boat, and I was trapped out on Lake Michigan. They won't let you back into shore until like after those races are over. So you're out there for like 12 freaking hours. You run out of food. You run out of everything. You're hot as hell.
Your thong is starting to chafe.
Yes.
Get the full scoop by checking out the archives at tastylive.com.
Global markets never sleep. Explore them with Forex on Tasty Trade. Get in on 80 plus Forex pairs, 24 hours a day, 5 days a week. FX marks the spot. Trade it on Tasty Trade.
Trade size varies between traders. In a larger sized account, a trader might trade 10 contracts per transaction. In a smaller sized account, a trader might only trade one contract per transaction. The term tranche allows us to quantify and size to a common denominator. One tranche would represent normal trading quantity. Two tranches would represent 2 times the normal quantity, signifying a larger trade size. Of course, trade sizing is immensely important. We recommend a tranche being far less than your max exposure. Tom, when you're scooping the offer, what are you doing?
That means when you're scooping the offer, you are buying whatever you can get your hands on at the best available price.
What does it mean when something trades by appointment?
Trading by appointment is when like you're in a pit back in the day that had like 1 or 2 market makers in it, and if they were having lunch, you had to make an appointment to make a trade with them.
In the pit, if you said, I'm gonna buy your book, what did you mean?
If you're going to buy the book, that means you're going to buy everything that is posted in an electronic book. So every resting order that's posted in the book up until a certain amount.
If you say take a fill, what's happening?
If I'm taking a fill, that means I'm a broker, and if I'm a broker, that means I did something horribly wrong because I'm a market maker.
If you say way to go out on a ledge, what are you doing?
Way to go out on a ledge is just another expression when you make fun of another trader who's not willing to take any risk, who's very risk averse. So when somebody's very risk averse and doesn't want to do anything risky, you say, "Hey, way to go out on the ledge."
When you say you're going to whack the bid, what are you doing?
When you whack the bid, that means you're selling at the best available price.
A scoopy. What's that?
Scoopy! That's one of my favorite. That's when you're just like scooping something at the bottom, like, you know, you bought something and it never goes lower. Scoopy.
Back in the pits, you guys call them teenies. What are teenies?
A teeny is a 16th. So before we went to decimalization, we used fractions. And we used 16ths under a certain dollar amount.
Do you want the penny or the position?
Well, that's always something. The penny or the position is, do you want the trade? Then just pay up to get the trade. But do you want to squeeze it for a penny? That means you're just going to wait until you get filled.
When you say Omaha, what happened?
When I hear Omaha, I know I've gone too far.
Tasty Trade is now on TradingView.
So I studied economics and international relations, and I wanted to time you're wrong. And so, for me, every macro narrative begins with what's the price action saying, rather than this or that economic indicator or some such thing.
U.S. retail sales data seemed to surprise higher, but for some strange reason, we'll get into what it was in just a moment, bond markets and the Fed didn't think that this was necessarily good news. So what does this mean going forward, and how does this set us up for the market's perception of the U.S. economy as we get into the second half of the year and start to think more acutely about economic growth? That's what we're going to cover here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And the markets, to be sure, certainly liked today's retail sales report. And indeed, that seemed to be the cue for stocks to launch higher. But nevertheless, one does have to ask the question and look under the surface, how is the U.S. economy actually doing? And those details are perhaps not quite as encouraging as the markets thought they were. Here's the performance that we see, and here is around where we get that retail sales report right here. We can see once we get it, the S&P 500, the Dow, they inch higher. It's a similar story for what we got in the Russell. So the markets did like this data, and at the headline at least, it certainly seems to make sense. Why? Overall retail sales up 0.6% compared with the 0.1% consensus. And indeed, as you look down kind of the various permutations of this data, you see that the control group better. Even if you exclude autos here, it's a little bit better, although not by much. The gap narrows to just 0.2% from this gap here. So autos obviously an important consideration here, but nevertheless, the numbers look in all better. In fact, this increase in the year-on-year reading up to 3.9% was the first uptick in 4 months for the year-on-year rate. So on the face of it, these are certainly encouraging until you look just a peek under the surface. Here's the breakdown by category, and you can see here's retail sales. Here you can see they fell over the preceding 2 months, down 0.1% and 0.9%. Here's the 0.6% increase. And the thing that really stands out immediately is this motor vehicle component. And to some extent also building materials and equipment, which is why it's not just a story of one category per se. It's why even when you take autos out of the equation, you still get this little increase, although it's much more modest. But this is really the main story because motor vehicles are between 20 and 22% of the retail sales total, which of course makes sense. Cars are one of the most expensive things that retail buys. So not surprisingly, it's a very large part of the tally here when you take the amount of money spent against units moved. So what you're looking at then is a situation where, to be sure, this very potent increase of 1.2% in June is an understandable way to power retail sales to better than expected results. To some extent, the 0.9% rise in building materials is likewise a standout, but it still is a smaller component of the total. It's really this motor vehicle bit that is the driver, given how important this is for the headline tally. But consider that this comes after 2 months of significant losses. A 0.7% decline in April and an eye-watering 3.8% decline in May. And when you add all that up together, what you end up with is retail sales, at least in motor vehicles terms, that are on net down about 3.3% in the second half of the year, or in the second quarter, rather. In other words, the 1.2% rise is nowhere near enough to offset these losses earlier in the second quarter, and that, of course, is echoed, albeit with some diluting in the overall numbers. So retail sales on the whole actually fell over the course of April, May, and June. And that, of course, sets up an ominous sort of a backdrop for what GDP data will do, because already in the first quarter, if we discount all of these shenanigans with front-running the tariffs, this 40-ish% swing in imports and the stuffing of all those imports into inventories, which then gives us this surge in the investment component, of GDP. It's how you end up with a nominally negative GDP number in the first quarter. So take all this noise and let's chuck it. Because as a lasting thing, it's obviously not a factor. This is front running of tariffs that have since arrived. And moreover, when you take these components and you consider how much of GDP they account for, but for these wild swings in the high double digits, which are very abnormal, all these components add up to a pittance in the overall calculus of GDP. By far the biggest component is household consumption. And what we saw was that in the first quarter, it was the weakest since back here, going back almost 2 years. And we end up with a story now, given this guidance from retail sales, that seemingly points to another weak set of consumer numbers in the second quarter, which of course, given that this accounts for such a dominant part of GDP, 68, 69%, depending on the quarter, is telling us that the underlying economy is actually slowing and slowing considerably. And perhaps this is why, in the wake of these retail sales numbers, Fed policy expectations actually move to a more dovish setting, despite these ostensibly better than expected numbers. We end up with a little bit of a trim on this year's rate cut outlook. We're to 38 basis points now, so we're not quite sure we're going to get a second cut. Markets are now fully baked in for a single 25 basis point cut. They're 13 basis points in the direction of a second one, so that's narrowly better than even at 52%, but only just so. But the real disparity is for next year, where the markets are growing increasingly dovish, including today, which is how you get this net more dovish move in the sum for the outlook between now and the end of 2026. For next year, we've moved out to 73 basis points, which essentially means we've all but completely discounted 3 cuts next year, whereas the Fed only sees 1. And so the markets are clearly signaling here that what this retail sales data means is that in a optics sort of way, this probably means that there's maybe a little bit less scope for rate cuts this year. But this does not change the trajectory of economic growth in a more positive direction. It just delays rate cuts and pushes them downwind. Because indeed, the weakening of the economy continues all the same and is in fact made more apparent by this data. Tellingly, in this context, the Atlanta Fed's GDP Now estimate of second quarter GDP numbers that takes in incoming economic data and then feeds them into this model that's updated sometimes daily, as long as we have data to look at that is relevant. We now see it was revised lower today, not higher, on the basis of this data. And that's largely, if you actually see what the Atlanta Fed flagged as the reason for the adjustment. And here a quote is perhaps most appropriate. The Atlanta Fed very directly says that what they did was downgrade personal consumption expenditure expectations. So the markets looked at this, as did Fed economists, and collectively came to the conclusion that in the wake of these apparently better than expected retail sales numbers, the consumption piece for the second quarter looks worse. not better. With that, we get another view of where consumers' heads are at, going now into the second half of the year, with the last bit of notable event risk for the week, the University of Michigan Consumer Confidence Survey. And here you can see we saw a very spirited rebound off these COVID equivalent lows. These, of course, were the post-COVID bottoms in sentiment here. And not surprisingly, sentiment was declining as inflation expectations were rising as a consequence of the pandemic's many disruptions. And once inflation started to fall, once the Fed really started to lean into rate hikes, you can see this is, of course, the beginning of 2022 right here, where the Fed really starts to hike. Once that starts to have an effect and inflation expectations decline, sentiment improves. As you get the advent of tariffs at the beginning of this year, inflation expectations surge and have in fact surpassed at one point the COVID peak. Sentiment craters. Fast forward to the June survey and the decline in inflation expectations from 6.6 to 5%, looking 1 year forward in these numbers. That gives you a potent jump in sentiment. As we look ahead, we can see the overall index is expected to nudge up just a touch, but expectations looking forward 6 months or so, as well as the assessment of current conditions, a little bit weaker in the forecasts. And perhaps that makes a bit of sense, warns that actually the headline figure might disappoint. And that takes us back to these inflation expectations as a driver of sentiment. Now, we just saw earlier this week that although the overall CPI report looked encouragingly normal at first blush, and the increase in headline inflation matched expectations pretty much exactly, 2.7% increase in the headline from 2.4. The thrust here came not from services where inflation already is the most dominant, and that's not surprising. Services is the biggest sector in the economy, but from goods, suggesting that the impact of tariffs is starting to appear. In fact, here's the change in monthly contributions to year-on-year figures. We can see the overall headline figure rose by 0.3 percentage points. That's from 2.4 to 2.7. But the thrust here is 4 times larger on the goods side than it was on the service side. If we actually look at the momentum of prices rather than just their levels. When we then got the PPI report, that seemed to continue. The goods component in PPI saw its first large increase in quite a while, and the largest since back here, January. So this is now a very sort of straightforward appearance for inflation linked to tariffs. We can obviously see that goods inflation has been basically non-existent going back for 2 years until this. Moreover, if we look deeper into the price dynamics here, we find that at the very beginning of the U.S. supply chain, at the intermediate demand level, before goods essentially go from who initially begins to have them at the wholesale level, then moves them on to final distributors that then put it out in stores and, of course, make it a retail-facing item. At the very beginning of the U.S. supply chain, margins got absolutely smoked 3 months ago. In fact, this is the biggest decline in wholesalers' margins since back here in 2013, the worst in 12 years. And for the subsequent 2 months, those margins didn't exactly keep pace, but they continued to deteriorate, suggesting that wholesalers are eating inflation costs, ostensibly from higher input costs around these tariffs, without passing them on to consumers. This is, of course, or even to final demand distributors, so wholesalers downwind along the supply chain. And in fact, as we look at corporate earnings reports, we see companies attesting as much. So with all of this in the inflation data, there seems to be a meaningful risk that consumers have noticed that the price of stuff seems to be heading higher, and that the thrust there seems to be significant and more notable than it's been in quite a long time. Now, if this feeds into these one-year inflation expectations and we get a nudge up here, given how this has been the driver of sentiment for the better part of 4 years, one would expect that sentiment would then deteriorate and give us a disappointing outcome, which would then, of course, make the second quarter story that much more ominous. If consumption is as weak as it appears in the first quarter, and it looks like it's on a pathway in the same direction in the second, if not worse, then all of the growth concerns on display in the first half of the year, they have the capacity to become still more acute. Now, you might say, what growth concerns? Stock markets hit a record high in the first half of the year, and that's certainly the case. However, as we keep going back to here over the past several days, notice that in the first half of the year, stocks, whether you look at the S&P or the NASDAQ, rose only a touch more than their normal 6-month average, but those gains were absolutely dwarfed by a dramatic US dollar sell-off. The dollar fell 9% against the yen, almost 40% against the euro, over 25% against gold. And so if we consider stock markets up 5.4 or 7.9% up, it's important to remember they're up in dollar terms. Factor out the influence of the weakening dollar on inflating these asset values and express them in any other major currency, and you end up with a loss for U.S. equities in the first half of the year. Meanwhile, for all the fire and fury in the Middle East, crude oil fell 9.2%, and the front end of the curve continued to price in rate cuts. Front-end yields fell. And whatever happened in crude oil clearly seemed to suggest that the markets are more concerned with demand destruction than they are with supply being disrupted. And so, again, just a small look under the surface, and we end up with markets in their price action telling us we're not concerned about something cataclysmic. In fact, this whole Sell America dynamic is obviously not something that stands out, because clearly the decline in 10-year yields suggests that investors are perfectly happy to lend to the U.S. sovereign at favorable rates, because their faith and their confidence in the faith and credit of the U.S. government is unshaken, despite recent events. But that, in fact, what they're still seeing is rate cuts and demand destruction. And of course, against that backdrop, a weaker U.S. dollar makes quite a bit of sense. That dollar weakness then is not about jettisoning U.S. assets, as the 10-year would surely attest. It is about getting ready for an easing cycle against the backdrop of something that starts to smell like a recession. And so with that in mind, if you then get aggravation of these dynamics as you head into these numbers, and if they disappoint because inflation expectations here tick higher, the story for the second quarter starts to look a lot less resilient than perhaps the nominal dollar-based equity market levels and valuations would suggest. With that, we have today's episode of Macro Money. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things may go from there. We are going to be off here next week, but Macro Money will be back the week after. In the meantime, I'll be surely still commenting because I can't help myself on the platform formerly known as Twitter and on Blue Sky at Ilya Spivak. If you're watching this on YouTube, like and subscribe. In the meantime, happy trading.
With rate cuts back on the table, are there any trades that you're watching in particular?
Well, rate cuts have never been off the table, but every time bonds drop, I think they're a buy.
Not really watching any specific trades in the interest rate space. I do keep an eye on, the futures options like the ZBs, the ZNs, the ZTs to see if there's any volatility types of plays that I can integrate into them. Unfortunately, I don't really feel like there is a really great micro future to trade the changes in interest rates just yet. I feel like they need a little bit more volume, but when those get a little more active, that will be definitely one way I will be participating.
Yeah, I am. I would say, honestly, the dollar trade. And I know that is one trade that has been very crowded as far as a lot of people are short the dollar. And if you look over the last couple of years, typically when interest rates are higher, the dollar is higher. And we've seen the opposite. So it would definitely be the dollar and how I'm going to trade that based on what happens with rate cut.
When you've got a futures contract that's in contango, what does that mean?
Futures, unlike stocks, have multiple prices appropriated to them. That's known as the forward curve. So when a futures forward curve is in contango, that means that the front month is trading cheaper than the corresponding futures back month. So you'd see that forward curve most likely looking like this in terms of prices.
And backwardation, what does that mean for futures contracts?
Backwardation is the opposite of contango. So where contango front month futures contracts are trading cheaper than the back months, backwardation is the opposite. So those front month futures contracts are trading richer than the corresponding back month contracts.
Trading is hard enough. Here's what liquidity is. You want to be like water. Liquidity is in reference to how easily you can get in and out of a position, from volume to open interest to actual price at which you can buy or sell your position. It's important for all traders, from stock traders to futures traders to options traders or even crypto. Tight bid-ask spreads and high volume are characteristics of good liquidity.
On today's Trader Taste Test, Tom has a fever, and the only cure is the KFC Chizza. What? Let's go.
Let's see what we have here. Okay, I don't think it's elevated chicken parm, okay? I don't know.
What are your thoughts? Just visual presentation.
He's just going in with his hands.
It's pretty beautiful. Let's see. I'm going to be totally objective.
Okay.
Impossible.
Okay, Jamal, you're black. We're eating fried chicken.
Yeah, right. I knew it was on there.
warm.
No, I like it. It's hot. It's delicious.
It rivals the chicken parm in prison.
Out of 5 stars, what do you give it? 1. I'm going 4.2.
Wow.
I'm easily impressed, as Tom will tell you, though, but I think it's very good.
3.5, just because I like Kentucky Fried Chicken.
Come on. Do you want to be Kansas?
3.7. I gotta be real. 3.7.
Okay.
Because the chicken's good. I mean, the chicken's not bad. The sauce tastes like pizza sauce, like bad pizza sauce. I like it.
Out of 5, what do you give it?
3.5.
That's what you do. What?
He likes it. 3.5 stars. He doesn't like it a lot, is what he's trying to say.
It's an elevated. It's an elevated.
It's an elevated nothing.
It's a chicken. It's actually pretty good.
If you missed the live show, here's our cherry on top weekly recap.
You know what my first concert was when I was very young. It's quite embarrassing.
Anson.
How'd you know that?
I mean, I feel like everybody.
How did you know that?
Because who else was popular then in like the late 90s?
Oh my God,
That's amazing.
That was cringe. There it is, the song. Yes.
Yes. All right. Good luck. Good trading. Let's go eat some roost.
Peace. Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
What is going on, everybody, and welcome back to Risk and Reward with Gus and Errol. Gus, what's going on, brother? We got Dame Lillard. How are we doing today, brother? I know it's been a crazy week in the market. We've been rallying to the highs, been selling off, and kind of holding near these highs. How are we doing, though?
Yeah, that we have. A little bit of stagnation, but we do continue to push through and make higher highs. To those of you who are confused by Errol's opening statement, it is breaking news. Damian Lillard back to the Trailblazers. Big deal there. 3 years, $42 million. Congrats to Dame. I see we have some excellent conversation going on in the chat about your preferential rounds. 30-06 seems to be a favorite. I can get behind that. Doing well. Positions are moving how they're supposed to for the most part. I will say this past 10-day period since we've kind of stagnated a little bit. I've mentioned to you a lot that I've just kind of been long delta until proven otherwise.
Right.
We're starting to test that until proven otherwise sort of level. And so there has been a lot of cutting losses in the past week while, putting on some new things as well. We put on UAL, which did not work out for me. I've already cut the losses on that position. Unfortunately, you gave yourself a better time horizon. It's just been this stability. You may not know this, but it's really easy to trade when the market just goes straight up. It's like makes it super easy.
It makes it very difficult for myself, actually.
Oh, yes. I suppose for somebody like you, perhaps. But for me, I like it. I like it when stonk go up. So, this bit of stagnation has been hurting me, but not burning too big of a hole in my pocket. Still doing well in the year. Can't complain.
No, I hear you. We'll kind of see how UAL and some of those other airlines kind of perform and kind of digest all those news. I know I got 29 days left till expiration, which I am fortunate with that one. Did you look at Netflix? Are you doing anything in there?
No, I have nothing on with Netflix. They are after close tomorrow. I do.
Yeah.
No.
Is it?
Today's Thursday.
We're gonna have to double check.
Oh, it's after close right now. Man, I thought all day it was Wednesday until right now. I came and sat down in the studio thinking it was Wednesday. How about that?
It's one of those.
Shows you about how good. Hello, guys. Sports news. Yeah, shows you about how well I'm keeping up with things these days.
After the bell, what do we got right here? We'll get into these slides here in a moment. We're going to talk a little bit about Peter Thiel making a big bet on Ethereum. It's looking like Netflix taking a little bit of a hit right now.
Yeah, but before we do, we got to talk about this astronomer CEO situation.
Oh,
That's
tough.
It's the talk of the town
That's
today.
tough.
For those at home not aware, which it'd be hard to be unaware if you've been online at all today, but the CEO of Astronomer, which is a small, what did they do? Do we remember what they did?
I didn't look too deep into their
data
company
management,
and exactly something along those lines.
Yeah, basically corporate buzzword company based out of Cincinnati, Ohio. But their CEO last night was caught on camera at a Coldplay concert, rubbing all up and giving some loving to their CPO, which I did confirm is actually is Chief People Officer.
Oh, it is people.
Yes, it is people, and she's head of HR. That's why people have been referring to her as head of HR. But yes, People Officer, not Product Officer.
Did you hear a little bit about more of the lore though?
I didn't. I mean, I've been keeping up with it all
The lady
day.
next to the right of her, that was like had the oh my gosh face. I believe the head of HR just gave her or just promoted her.
Oh,
right. So this can come back with some more conversations because she's also
interesting.
The lore might be going a little deeper, but I don't know. His face has been plastered everywhere. I know they're scrambling online. But it's just crazy how much fire
online, and the situation just continues to develop and worsen today.
Yeah.
I just mentioned to Errol right before we came on air that the wife of the CEO has now changed back to her maiden name in her social media profiles, which is obviously no good. But as we talked about earlier, is this the greatest publicity stunt in the history of publicity stunts? Here I am on air talking to our audience about Astronomer, this company we've never heard of before.
Right.
So, is there such a thing as bad publicity?
Is it smoke and mirrors? I don't know. At the end of the day, we'll never know, but we do know that something like this can give you a lot of publicity. So, I mean, what a marketing strategy. If you got some friends that own some arenas, hey, point the camera to us. Maybe something not that diabolical and scandalous, but it's not a bad marketing idea because now people are going to be watching those videos and be a little bit more aware of them.
Yeah,
So
if you got friends at the right places,
you can get creative with that.
That's
I honestly think it's a great creative marketing ploy if someone were to, spin it into something that they want. But Jumbotron marketing, but Peter Thiel in crypto.
Yeah,
Gus.
let's talk about it. Peter Thiel, we talk about the other founder of PayPal all the time. We don't seem to mention Peter Thiel very often. Let's dive in. You kick us off. Yeah.
All right, there we go. Peter Thiel, billionaire tech investor and co-founder of PayPal and Palantir, known for his early investments in disruptive tech and crypto. So that's Peter Thiel. If you didn't know who Peter Thiel was, PayPal, very relevant. Elon being a little bit more relevant for the face of PayPal or just being tied to those names. And then Palantir. Palantir has been extremely relevant over the last, 4 to 8 weeks. So this is where Peter Thiel plays a role in
closer to 4 years.
Closer to 4 years. Yeah, 5 maybe. I think 2020. And then Tom Lee, well-known market strategist, co-founder of Fundstrat Global Advisors, recognized for his bullish stance on crypto, pro-crypto, especially Ethereum and Bitcoin. But this is who Peter Thiel is. If you're wondering, why is this even important? Because why do we even care that so-and-so believes in Bitcoin? I believe in Bitcoin. I don't see my name in headlines, guys.
Yes.
So what happened, though?
Peter Thiel taken a 9% stake, I believe it was, in Tom Lee's company. This company is essentially doing with Ethereum what MicroStrategy is doing with Bitcoin, to the best of my understanding. They are loading lots of Ethereum, and that appears to be their primary business strategy. You want to start a business where we just load Dogecoin?
I'm down for Doge because I feel like Solana's next.
Oh, you think Solana's
We could take Doge. I mean, it was Bitcoin, Ethereum.
Solana gives me SafeMoon vibes. I can't really explain it.
What, like not a lot of risk on? Like Solana gives you...
Like hype then die sort of vibes is what I get out of Solana. Maybe XRP. You want to do XRP?
XRP is a buzzword. I think XRP is turning into a buzzword.
It's trending on TikTok right now. We could probably syndicate pretty easily.
We could.
Okay.
I think we could.
If anybody wants to invest in our in our company that only exists to buy XRP, instead of investing in XRP yourself, get at your boy.
Before we move on real quick, though, what do you find more utility in or see more utility in from a personal point of view? Let's say you're the CEO of a company. You guys are going to invest in either Bitcoin or Ethereum. MSTR took the Bitcoin approach. Tom Lee and Peter Thiel are taking the Ethereum approach. Which one would you choose?
If I have all the money in the world, it's Bitcoin.
Really?
I would say, yeah.
Okay.
I mean, I think why not? I think that if money is no object, why not just choose the most well-known cryptocurrency that there is? Because if your stance is that crypto is going to grow, everybody who is coming in to enter this crypto market and grow it, as you predict, is buying Bitcoin first.
Right.
So I think I would have to say Bitcoin
in terms of
from a growth angle.
Okay, a growth angle.
Yes, and Bitcoin also. And this is this is kind of like a doctor talking about surfing here. I don't really know exactly what's going on, but I know that Bitcoin is more tangible. It holds its value a little better. It's more of a real asset than a lot of other cryptos. There's because there's like the three boxes something has to check to be an actual currency, right? It's like a store of value, a medium of exchange. And my Econ 311 professor shakes her head. I don't remember what the third one is, but Bitcoin checks all three boxes. So yeah, I feel Bitcoin just has the most strength. But it all depends on your angle, your risk tolerance.
It's a great point. The only reason why I actually lean a little bit towards Ethereum, just because I feel like Ethereum is one of the only cryptos we've seen real utility of. I know it was super hyped up, but I thought that the NFT mania that was going on was a great example of how the infrastructure of Ethereum and smart contracts could be used. And I feel like I've never seen anything with Bitcoin but headlines. So maybe it's just a store of value, digital gold, they say.
Perhaps it's just who we're talking to, because that's like kind of the same view I have on Bitcoin.
Right.
Yeah.
Great point. But why does this even matter? Well, Peter Thiel is a big headline in the crypto space, especially anybody that supports these new industries or sectors, whatever you want to call it. But it's a signal of confidence, right? If Gus is running a massive corporation and he's been investing in Bitcoin over the last 5-10 years, and his name's in these headlines. If I see Gus in the headlines, he's purchasing on Bitcoin, I'm going to be a little bit more confident in doing so. But this could be a little bit of a catalyst for a lot of investors. But don't you find that kind of interesting? It's like nothing fundamentally changed or technically changed. It's just a headline about a big person in crypto showing their support, and we're getting some headwinds off of it. We're getting some movement.
Yeah, it's true. I mean, we see that happen all the time. Right. Sometimes, and there's the way that sentiment can spread like through people is very interesting. Something like a common one that I would reference is if a SpaceX rocket blows up, Tesla will go down.
Oh, right.
And it's like, why? Obviously nothing fundamentally changed about Tesla, but it's the whole ecosystem. So yeah, I do find that to be an interesting part of this. And I also think that kind of what you just said can be applied to crypto as a whole. Like in terms of take Bitcoin, for example, or Ethereum, nothing has ever fundamentally changed about these cryptocurrencies. It has just been this progressive snowball of more and more people buying into the logic of cryptocurrency or just using it as a growth asset, whatever it may be. But yeah, I think that this is an interesting microcosm of that as well.
100%.
But yes, and as somebody mentioned in chat already, BMNR is the ticker that we're talking about here. But yeah, so as we just discussed, credibility boost from Thiel's backing is kind of the biggest factor that's even moving these right now. And I suppose, having somebody that has billions and billions of dollars in their corner supporting your company and with equity in your company, perhaps there is some tangible thing you can tie to that as opposed to just a credibility boost. But that creates investor speculation when somebody that is really good with their money is chasing after something. You're compelled to do the same. It's why I bought Berkshire Hathaway for so long, though I don't hold any anymore. May Warren Buffett rest in peace. I know he hasn't died. And then yes, also potential impact on Ethereum related valuations. This is a big one, especially as these Ethereum ETFs become more widely available. And there's just, I don't want to use the word brand awareness, but it's kind of, it's kind of what it is. Yeah, it further pumps Ethereum in the news cycle, gives it a little bit more validity. And yeah, perhaps props up that valuation a little bit.
Oh, completely agree. I mean, I wonder what a lot of the valuations are going for on some of these NFT projects. I mean, we could clearly see based off of the price of a lot of these NFT projects and how that held. But I wonder what those evaluations were on projects built on Ethereum in 2020 and 2021. Because I do know, it got a lot of celebrity support. Like we were just talking about the influence that guys like these big names have. I mean, I remember Justin Bieber had bought a Bored Ape, I think it was. And it's like when the celebrities
started on the Bored Apes.
The Bored Apes, brother. When the celebrities are buying in, their peers, Justin Bieber's peers and the other celebrities' peers are buying in too. So just kind of seeing that human behavior,
yeah, it's true. I mean, kind of no matter how rich you are, your friends are your friends. You want to do the same activities your friends are doing. And yeah, holds up all the way across the board.
But what are some of these implications? Crypto stocks and altcoins may see a sympathy move similar to Ethereum-focused companies may rally on this news. I don't trade too many altcoins. I really don't. I know altcoins get a lot of volatility, and sympathy moves are not foreign to like the equity markets. We see it all the time. Something like Tesla, the head of the EV space, has a massive rally. We may see a little bit of a rally in Rivian or whatever else might have exposure to the EV space. So could see something similar in the crypto stocks. I'm not a big altcoin trader, but to somebody that was getting into altcoins, what would you classify as an altcoin to somebody just getting in?
Like right now?
Yeah. I've heard a couple different literally anything off the top of your head is probably a coin.
Fartcoin's at like $1, man. That's real stuff.
And for anybody new, like, yo, what is Gus and E talking about? What's an altcoin? Anything outside of Bitcoin? Am I mistaken, Gus?
I think that at this point you could say Ethereum. Yeah.
Ethereum, yes. Bitcoin, Ethereum is safe to say nothing else would fit that category, would it?
I don't think so. I mean, hilariously, Dogecoin has kind of become like sort of relevant.
How is that still a household
sort of
name?
valuable?
It kind of became a household name.
Man, I'll tell you what. Can I track what Doge is trading out on here? I so can.
Do you still have
Tasty
Doge?
Crypto? Thank you, Tasty
you
Crypto.
You still have Doge, or did you ever get into Doge in 2020?
I did. Yes. Maybe I've told you this story before.
Yeah.
Yeah. It's at 21 cents now. Yeah. I got into Doge in 2020 just as a complete joke. Right. We were bored, and I was like, oh, let's throw $20 into this stupid Dogecoin. And that was when it was worth well less than a cent. And then it went to a cent. I remember that. And we like 20x'd or something like that. And I was like, okay, I'm out. And if I had kept holding, as you can see now, I would have 20x'd another time. Right. That would have been quite the trade. What's be $8,000 on $20 buy-in? Yeah. 20 squared. So yeah, perhaps a little bit of a paper hands situation on that one. I recently learned that maybe I mentioned this to you. The third co-founder of Apple sold his 10% stake back to them for $800 when they first started the company.
And we didn't speak about this, but we talked about how a $5 investment in Apple X amount would have been at whatever X amount.
Yes,
we didn't go into those details.
Yeah, the third guy that founded Apple, Ronald Wayne, I believe is his name. In 1975, like the year they started the company, he decided he didn't want to be involved, and he sold Jobs and Wozniak his 10% stake for $800, and that would be a $300 billion position now. So my whole point is, there's people with worse paper hands than me. All right,
my point is diamond hands.
There's been bigger mistakes made than me selling Dogecoin at 1 cent.
Oh yeah, I mean anybody that had the opportunity to even invest in Uber. You know, speaking of Apple, Uber came a decade later. And I know a lot of people passed up that opportunity that had a little bit more capital under their belt.
Yeah, and it's funny because companies that you would totally expect to pop out of their IPO will sometimes die as well. Like Coinbase comes to mind. Coinbase is just now about to pass their IPO like opening day peak.
Oh right, yeah. It's like that initial volatility everyone's excited for. I know we even have like IPO traders. Like there's some traders that specifically wait and look and study IPOs.
Oh yeah. Yeah, right. I enjoy trading IPOs, and I will do it where options are available, because very often you will see these companies just inflate like crazy out of IPO because everybody just can't wait to get their hands on their slice of the pie. And then, that's almost always unjustified. I remember I made good money trading the Snowflake IPO, which was 2020 or 2021. Somewhere around there. Yeah, ticker Snow. And it was the same thing where there was this crazy hype train for like the first 2 days, and it mooned. And then there's no way that this pace is sustainable or that this price is justified at all. And it's the most brain dead trade in the world to try to get that coming back down. Yeah. And the premiums are through the roof. It's great.
100%. Sometimes whenever those IPO, I'm like, I hope the options chain hurry up and comes out for this ticker so I can trade it.
Thoughts on WorldCoin, says Aaron Sin in chat. I've never heard of WorldCoin.
Never heard of WorldCoin either.
All right, there's our thoughts. I can't say too much more about it. I don't want to speak out of turn here.
Yeah.
Does not appear to be a thing we have on Tasty Crypto, which I've never heard of it. I suppose it's not that crazy, but anyway, we can keep it moving here.
No, but that's gonna wrap it up with the Peter Thiel. Peter Thiel. And Ethereum. I mean, Ethereum's still catching all of the headwinds. I think Ethereum's going to end as the top dog in the race. But that's going to be my take for.
I know Ethereum has been adapted more by people who are trying to give you a tangible means of exchange into cash. Like I know in Europe, the crypto ATMs are becoming an increasingly prominent thing. And Ethereum is the primary.
As in, I can walk up to this ATM and withdraw cash. Like what is the ATM doing? Is it
I suppose it liquidates your currency. I would guess it either liquidates your currency for you or it transfers your Bitcoin into whoever owns the machine's wallet, and then they give you the cash.
Yeah.
Something like that.
It's like a pancake swap inside the ATM, or like is it like a Uniswap built into the ATM?
I mean, there's like a bunch of little guys in there. But so I do think that there's some validity to be had with that. But honestly, I mean, with crypto right now, I feel like there's no bad buys in terms of like a long-term holding context. I just think that this is we're still kind of on the forefront of this whole thing.
I don't know. Sentiment is really weird. It would be interesting to study more of the psychology about sentiment because, you know, why is crypto not as exciting right now when the crypto industry is barely even, I feel like we've barely even seen half of what we're going to be seeing built over there.
Yeah, have you seen there's a bill in the works right now to make banks have to acknowledge crypto holdings when giving mortgages. I don't know if you've seen that.
Oh.
Yeah, that's
Like acknowledge it in what sense?
like acknowledge it as an asset.
Okay.
Like the same way they would. Like, you know, you can
I think
leverage,
rightfully so.
Yeah, you can leverage a mortgage against your house or whatever.
Absolutely. There's capital gains tax on crypto.
Yeah.
As it should.
Yes. So we're just now getting to where that sort of thing is formalized. And I think it'll be interesting to see what cryptos they initially choose to acknowledge in that, because you could have all kinds of funny situations. Like you wind up on some shit coin that you see shilled on TikTok or whatever, and then you put in $1,000 and it 100x's, and then suddenly you can go to the bank and say, hey, my Shiba Inu, or you know, whatever, my Shiba Inu is worth $100,000, bro. Can I get a loan?
Yeah.
So yeah, I think there's interesting implications with it, and they'll certainly have to pick and choose the cryptos. But I do think that's an interesting.
I think it's valid. I think it's, you know, I think it's a right approach. I think it's heading in the right direction because we do.
I mean, is it like I think it's so obvious. I mean, is it not an asset? Is it not worth money?
When you have the stock market, which is like the cousin, it's like, Dad, why did he get to? But not, you know what I'm saying? So I think that's the right move. I think it's a great push for the industry as a whole for crypto.
Yeah.
So
yeah, absolutely. It's very interesting that's coming around, but. Yeah. What are you eyeing anything for the rest of the week here?
No, I know we got some earnings, traded a little bit of UAL, got 29 days left to expiration. So hopefully that could come back a little bit. I know Netflix, what I wanted to do originally was I took the Netflix position off. I wanted to roll the profits from UAL, the imaginary profits from UAL into the potential earnings trade for Netflix. But what I'm going to do, like we kind of touched on too, is just maybe look for some outlier moves from earnings, some exaggerated moves, pick some of those up. But I'm glad I got the UAL one on. And I'm looking forward to seeing how Netflix is going to pan out, because it looks like anybody that sold an Iron Condor on Netflix, it might be opening up right in your breadbasket, or if you sold a Strangle, because we're going to close, or we might open up unched, as Dr. Jim would say, even though we put in a pretty high and a pretty low. 10 minutes later, we're at where we closed at.
Efficient market hypothesis wins again. we can never escape. But yeah, I do think that's interesting. And I will say, while I did not trade it, I was definitely bullish on the Netflix earnings call. You know, I think that we have to be really close to Netflix giving us some kind of big announcement regarding live sports. That's something that they've been kind of trying to make a foray into this whole time.
Live sports, as in like watching the finals, watching.
Yeah, whatever you may have. They did get a few NFL games last year. They covered the NFL Christmas Day games on Netflix. And that contract goes through 2027, I believe. Yeah, the NFL Christmas Day stuff.
So I feel like they're going to try and change. It's like a nice little on-demand catalog. It might change to something like a. I don't know what's a good comparison. There's so many competitors nowadays, but
I think that's the leg up that Hulu has on them, if you can name one, is that Hulu has the live TV offerings. I mean, that's how I watch live TV. My father, love you, Dad, pays for the Hulu with live TV, and I'm on there. But it works great. I mean, it really is like everything in the world. It's the same thing as freaking cable, which I wish we could just go back to at this point.
I mean, might as well.
But yeah, I mean, it's got everything in the world. It's got all the sports you could need, all that good stuff. So I think that Netflix is maybe trying to capitalize on some of that market share. I know there was also talks about Netflix getting into a UFC contract, because you know that's always been pay-per-view.
Yeah,
it's the idea, and UFC outspokenly wants to get rid of the pay-per-view model they've had with the ESPN.
It's been terrible for their fighters.
Yeah, it's been terrible.
For the top few fighters.
It's terrible for the viewers. I mean, like if you wanted to legitimately be a fan of UFC, I mean, nobody has freaking. I mean, it'd be.
The only body that
went north of $150 a month.
The only people that win in a pay-per-view is the people making the money from the pay-per-view, because it's not a great experience on the consumer end, and it's not a great experience for the people putting on the show.
Exactly,
They don't make that much money.
It's a really hard way to grow your sport too.
Yeah,
if you're trying to grow it, you're putting it behind a paywall. There's very few other 100%. Sports that are behind that type of paywall. I mean, they're all behind a paywall because you have to be able to watch them in the first place. But then you're going to paywall me a second time. Like I'm already paying for this thing to be able to watch your sport. So I do think it'd be a good thing for them to phase out. And Netflix is a way that they've talked about doing that, because that would still be a subscription model. You'd have to be a Netflix subscriber, and they would take some of that revenue and chop it up however they see fit. So I know that's been in the works. But yeah, I just think I think Netflix is interesting and could have some promise in that regard. I think that's they've done all this just with streaming. Yeah. They've never done anything live until last year.
How long until Hulu and all these streaming services are seasoned enough until we get a service that comes out talking about no ads? free this, free that, and then undercut all the other companies. Maybe, maybe not. But it'll be interesting to see how that evolves.
I mean,
it's
man,
cable again. We grew up with this.
Somebody monopolize
new to
this.
us.
Yeah, please, somebody monopolize this. I would genuinely pay like $200 a month if I could just get one place where I can actually watch all the games from all the sports.
Yeah.
And it just doesn't.
I cannot believe that's how it is nowadays.
Oh yeah,
that's the most absurd
and it gets even
thing.
crazier the more that you're into. I mean, if you want, if you want to watch, say Wimbledon, you need ESPN Plus to watch the early rounds of Wimbledon. If you like EPL soccer, if you want to watch Premier League, you need Peacock. You got to have Peacock.
That's me and Paramount sometimes with Champions League.
Yeah,
And then,
Champions League. You got to pop over to Paramount Plus, and you got to have this subscription, that subscription, and it just tallies all the way up. I remember seeing a study last year that to watch every NFL game last season, it would have cost I think $855.
That's insane.
If you wanted to actually watch all of them like legally through the desired means, and that's so insane. And I feel like it has to hurt these companies a little bit too, because like I'm not gonna pick up a new subscription. Like in the case of Netflix, did anybody subscribe to Netflix to watch the NFL Christmas Day games? I don't know that they did.
Probably not.
I don't know how many new subscribers you're really generating from that. People find a way to watch them, but it's it's just not through the desired means. So yeah, we need some consolidation in this regard, and I'm certainly not the only one to notice this.
No, 100%. Cable 2.0. We'll see what 3.0 is going to be looking like, but that is going to do it for our segment today. We got a little bit of risk, extra risk on the week. UAL had earnings yesterday. We'll see how that digests and pans out. Anything else before we look like you were gonna?
No, I was looking to I was just reading through chat here.
Yeah, we miss anything?
But yeah, no, I think everybody's just keeping up. But yeah, anyway. Appreciate everybody watching. This has been great.
Cool. Well, that's going to do it today for Risk of the Week with Errol and Gus. We will be back next Tuesday, every Tuesday and Thursday at 4:30 Central Time. Be sure to come and hang out with us. Thanks for taking the time to chop it up with us for a little bit. We'll catch you guys next time. Peace.